Reuters Global Investment Outlook Summit. I'm joined by Marty Fridson, CIO of Lehman Livien Fridson. Good to see you again, Marty.
Great to be here.
High yield has had a very interesting year as we saw a lot of investors rush into it in fixed income, and it's had its ups and downs. Clearly, is high yield overvalued as we head into 2015?
It is. The fair value spread on the B of A Merrill Lynch U.S. High Yield Index, by our measure, is 565 basis points. As of last night, it was at 453. So not quite an extreme overvaluation by our measure, but not cheap. And we're seeing the effect of this scrambling for yield and investors willing to accept less than they really should be getting compensated currently.
So does that mean that default risk is greater than some believe?
It's really not so much the default risk, although that's, the default rates probably will rise in 2015. That will wind up being a drag on returns. But the credit availability is really the most important factor in the equation. It's at a reasonably good level, not the best it's ever been. But the default risk is a consideration, but we're not facing even an average default rate of around 4.5% as early as 2015.
In terms of the overvaluation, are there particular sectors where the overvaluation is more precise? There's been a lot of high yield, for instance, in the energy space.
Well, the energy actually is cheap relative to its ratings, and the ratings outlooks on the whole are still positive. Now, that could change, but if you agree with a somewhat longer-term view of the rating agencies on this industry, it'd actually be a very good value. A lot of the overvaluation is concentrated in the more defensive industries, the classic ones being containers, healthcare, and cable TV and satellite, which is rich relative to its ratings and has recently taken a turn for the worse in terms of its ratings prospects.
Should rates increase next year, what happens to the high yield market? And do you think that the Fed will raise rates?
Yeah, I think that the market has a pretty good handle on it. Things could change, it could slip. I'd say the risk is for the tightening to happen later rather than sooner. But I think there's a question, A, how much of an effect that will have on longer term rates, although the Fed would like to see a parallel rise in the yield curve. They may find it difficult to push up the longer term rates simply because rates are so low in Europe and the economy is not looking very robust there. So it may be hard for our rates to rise under those conditions. So you may see more of a flattening than a general rise in the curve. So in that case, the high yield bonds wouldn't really be affected all that much. The tightening by the Fed would really be a signal of an improved economic outlook, which would be favorable in terms of the default risk. So the real change would come not so much from the Fed tightening rates, but from, at some point, lenders losing confidence that companies that are looking shaky can grow their way out of their problems. When they start to pull the plug on those companies is when you'll really see the default rate start to surge.
Based on previous cycles, when might that be, if not next year?
I would say that in 2016, I would expect the default rate to be up to an average level, which is about 4.5%, and to remain at an above average level for the next probably 3 years or so. And so in the course of that time, you should see some of those companies that operationally may not look a lot worse than they did 6 months earlier suddenly default because the banks figure they're better off pulling the plug now rather than letting them go longer and dissipate the value of the assets for recovery.
What do you think of some high yield outside of the U.S.?
Well, it of course is very dependent on the economic conditions. The main concentration outside the U.S. at this point is in Europe. We're seeing some growth in Asia, but the European market is wider if you adjust for ratings. It's a little deceptive because the European quality mix is much higher than the U.S. mix. So if you just compare the two, the U.S. looks cheap just because it's lower quality. But in fact, it's the other direction, not quite in an extreme where we would start to aggressively encourage investors to switch to Europe, but that spread has been widening because of the weakening economic outlook. So the performance will depend very importantly on whether the actions by the European Central Bank are successful. I'm is kind of skeptical about how effective they can be without the additional input of fiscal stimulus.
We end it there. Marty Fridson, thanks so much.
Good to talk to you.
I'm Rhonda Schaffler. This is Reuters.